Hey guys, Drew Rice here, and welcome to the Engineering Success YouTube channel, where each week I talk about different personal finance and career-related topics. Today I just have a quick video I want to get out reacting to the blow-up that happened on CNBC's show Squawk Box on Wednesday morning between Andrew Ross Sorkin and Joe Kernen. So I think this is a lot of really good lessons for investors and how emotions prey on investors during stressful times like what we've experienced over the last several months. We have prime examples of why you should be a level-headed investor regardless of what is going on in the current market. As you can see, Market Watch is where I first caught wind of this, where they went for the political headline talking about how Ross Sorkin called out Joe Kernen for not acknowledging the casualties and the negative sides of what has been going on in the United States, and basically trying to say that it's some type of, it's a political agenda on Joe's side. I don't really want to comment on whether or not I think it was, but let's go and play the clip. And where I was able to find this was at Raw Store's YouTube channel, so I'll have that link in the description if you want the link to the original video, but let's have a listen.
Tell us about what's happening
Still
right now.
looking at the coincident and lagging indicator. Let's see, for a while it was how can stocks be where they are because of oil prices? Remember that was your take then.
Right.
How can it be based on where interest rates are right now? Then it could be how can stocks be,
Right.
and then it was every single discussion you have over the weekend is about how can stock prices be here when the economy is here.
Right.
Now it's going to be your earnings, but can
Right.
you see how that probably isn't the
I'm asking
coincidence,
the
the stuff
Joe.
right in your face? We're going to have David Lebovitz on. He's going to say every client he talks to is asking him, how can the stock market be here when
Right.
everything else is going?
And that's the question. And there are a lot of smart people who have that view. You may
Are
not
they?
have that
Are
view.
they?
I
So
know,
is that the- how-
And first off, what I want to say is that right now Sorkin is giving a much more level-headed approach because that is a fair question. It doesn't really make sense that the stock market is, so close to the all-time highs with so much uncertainty in the market. That is a very fair question. We still have a lot of issues within the oil industry, within the travel industry, and just within demand and high unemployment. It is very understandable to ask the question of why is the economy acting the way it is? Is it because of the QE that's going on with the Fed? Is it because of optimism? Is it because of consumer optimism? What is the cause? That is a very fair question, at least so far in this interview.
Why is that the smart people? They've been wrong for 35%. Why are they smart? Just because they can see what's right in front of their nose? That doesn't make them smart. It makes them.
Look,
it makes
Joe,
them
you
not
missed it on the way
savvy
down too.
Makes them
Joe,
not savvy about the
Joe,
market.
you missed it. You missed Joe. You missed it 100% on the way down, and you missed the 100,000 deaths. So we can have this debate back and forth, and you can try to question the questions I'm asking. But there are smart people, including your friend Stan Druckenmiller, who has argued that the market has been over. Hold on. I'm not going to do this with you, Joe. Every morning you try to question the questions I'm asking. These are questions that investors are asking every single morning. I am just trying to get through some of this clutter. I may be right, I may be wrong. Investors may be right, they may be wrong. That's what makes a market. But it doesn't make people a good person or a bad person. It doesn't make it right to act the way you are. I'm sorry.
Okay, you yelled
I'm
at
not
the
gonna
poor
do it
guy
at this
about
hour.
the
I'm
guy
not.
yesterday with masks. Is like, why are you yelling at
I'm
me
not,
now?
Joe.
You just yelled again. I don't
I'm
know.
not.
I'm just trying to.
Go ahead.
I'm sorry.
No, you're not. No, you're not, Joe. I'm sorry.
Okay.
Go ahead with the news.
You panicked about the market, panicked about COVID, panicked about the ventilators, panicked about the PPE, panicked about ever going out again, panicked
And
that
you
we'd
didn't,
ever get
Joseph,
back to normal.
Joseph, you didn't panic
What
about
good is
anything.
that? What good is it? Why
Joseph,
not help
100,000 people died.
keep their head? I understand that.
100,000 people died, Joe, and all you did was try to help your friend, the president. That's what you did. Every single morning on this show. Every single morning on this show, you abused and abused your position, Joe.
That's totally unfair.
You abused and abused
I'm
your
trying
position.
to help investors keep their cool, keep their heads, and as it turned out, that's
You know
what
what,
they
Joseph?
should have done. That's what they should
the
have done.
news.
They should
Do
have
the news.
kept their heads.
Now, one thing I will say here is that Joe is definitely right in that part, that yes, investors should have kept their head, that if you were down and you had good investments, you should have been holding them. However, his attempt to create essentially a victory lap, pretending that, the market has fully recovered, everything's over, and it should be smooth sailings from here, I think is very naive. And I do think it shows a little bit of him being a permabull, which being a permabull is better than perma bear historically. But the reality is that, you know, you should have been somewhat wary and de-risking during the March and April downturn, because it was pretty evident that there was going to be economic drops, and Joe completely ignored that at the time. He kept arguing that, oh, it's not going to drop that much, while people like myself and Bill Ackman were shorting certain areas in the market and then buying up areas that had been hurt. Because, well, yes, I had a very strong conviction that the market was not going to go to zero because of this, I definitely understood the risk involved with investing in the market during March and April. And I understand that there's still a high amount of risk, even more so now that the market has come back up than there was during March. And this is one thing that we have to keep in mind is Joe and Andrew right here are kind of, Joe especially is acting as though it's either or, and this is something I've noticed he does a lot on CNBC, where he's either wants to either be all in that everything is bullish or all in that everything is bearish, and that's just not a realistic approach to investing, in my opinion. I think that so far, other than the political jab that was thrown in, and a little bit of the emotional raising of voices, I think overall Sorkin has been a little bit more consistent, recognizing and accepting that there is nuance to investing, that just because you think that there's going to be a negative impact on the market short term doesn't mean that you're suggesting people should sell out of their stocks. The two don't necessarily correlate, and the two really shouldn't correlate.
If they had listened to you, Andrew, we're supposed to be at about 8,000.
I wasn't arguing to go sell your stocks, Joseph. I was arguing about people's lives.
We understand
people's lives.
Andrew,
and that is it exactly. There, Sorkin has the point that investors really should take away from this, is that acknowledging risk within an economy is not the same thing as saying you should sell out and you should take losses. There's a huge difference. When I was buying during March all the way on the downturn on every red day, I knew that the market could keep going all the way down to what Joe says of 8,000. I didn't see that happening. I think that's definitely hyperbole. I don't recall anyone on CNBC saying that. Even Bill Ackman, whenever he was having his breakdown pretty much on CNBC, you know, even then we were looking at it maybe going down to like 15,000. But the reality is that you do need to acknowledge risk before investing, and pretending that there isn't risk is not a logical approach either on Joe's part.
The
global
argument.
pandemic.
Do the news. I'm begging you to do the news, Joseph.
It's a global pandemic.
I'm begging you,
Andy.
please.
It's a global pandemic, Andy, where per capita deaths, we're down near the low end of per capita deaths. We're nowhere near per 100,000. Most places are at 60 deaths per 100,000. We're at 29. So it's terrible that we've lost 100,000 lives. It's terrible. But it was never going to be that we weren't going to come back and that we weren't going to return to normal. And, you know, siding with Ackman and everything else, that, you know, giving credence to all that panic didn't help any investors at all, or people with their anxiety and everything else. So that's...
Now, the thing here, I understand what he's trying to say, and I definitely can agree that, you know, there was a little bit too much hysteria, and there still may be a little bit too much hysteria around the current situation, but he's not being realistic. I mean, saying that it didn't help any investors is pretty silly, especially when he specifically brings up Bill Ackman, when Ackman did arguably, I would say, at least as far as I've heard, better than anyone else during this downturn, where he 100x'd 27 million investment. You know, yeah, this helped a lot of people that were very good patient investors and were smart enough to understand what Joe's saying, that yes, the market would come back. Those people that were smart enough to invest then, yes, they've been rewarded, and they should continue to be rewarded, even if there's a temporary downturn in the near future. Long term, they should be still rewarded for this. But him suggesting that people shouldn't have worried about it is a very silly way of looking at things, because that's how you create a stock market bubble, is when people are investing without acknowledging the risk associated with those investments.
That's why we're here. to try and navigate people through, not trying to help Donald Trump. Anyway, let's look at Tesla. News overnight, Tesla.
That's the entire video from CNBC. Just to give a little bit more perspective on what I was talking about, on March 18th, which was the pretty much the market bottom, Bill Ackman, who is the CEO of Pershing Square Capital, went on CNBC and had a interview that was very famous / infamous at the time, where he was essentially arguing that everything was going to get worse, that things were not going to get better, that we had a lot more risk on the downside than we did gains on the upside at the time. At least that's the way it sounded, which this is one that really upset Joe, because he looked at it from the perspective of this guy is trying to, be a fearmonger and trying to get people to panic. But I don't really see it that way. I think if you actually listen to his interview, you can understand where he's coming from.
I'm an optimist, but beginning in, late January, I was getting increasingly bearish, and I woke up with a nightmare. And my nightmare was you have this virus that replicates and infects incredibly rapidly. Each person infects 2.5 people, each of whom infect 2.5 people. 1 becomes 2, 2 becomes 4, 4 becomes 16, 16, 256, 65,000. You get to just massive, massive numbers.
Yeah, and so what I really want to focus on here is the initial part where he talks about how he's an optimist, but at the same time, he was looking at this in January and saw what was going on in China and realized there were going to probably be negative effects because of how much our economy is linked to China without regard to whether or not it comes to the United States. And that was my same view. I'm nowhere near on the level of an investor of Bill Ackman. However, I had the same feeling. In January, the first week of January, whenever the first couple cases started to come out and there were first talks about it in China, I immediately started buying inverse leveraged ETFs against the semiconductor space because that's heavily influenced by the Chinese market. And I was able to make some gains in January while only using a very small amount of my portfolio, and that's because I pull out of most of my stocks about midway to the end of January, because I did kind of see that there was going to be something coming. Now, I definitely didn't time the market because I bought some before the March 11th first initial drop off of the cliff. However, I was immediately buying into positions come March because it was kind of inevitable, and I felt like there was a lot of false optimism in January and February in the market, especially because of the fact that everything was at all-time highs while you had this type of risk that was so heavily associated with the supply chain of the U.S. economy. And so people like Joe may hear this and think, oh, he's fear-mongering, this is excessive, but it seems pretty reasonable to me. I mean, don't get me wrong, listening to it in real time, it felt like every moment that Bill Ackman was talking, the market was just dropping more and more, but I was buying the most that day because of this. And so then I want to go to another part in this video. So at about the 340 mark. So this is where he talks about the risks going forward.
Not enough. And the reason why it's not enough is the only way, what's going to happen if we continue the way we are operating is until a vaccine is manufactured, distributed, and injected, we will go through a depression era period in the country, and millions of people will die around the globe, and as many as 1 million Americans are going to die. And it's just math.
Yeah, and so while he, at this time, was at least somewhat on par with what the models were saying, in retrospect, someone from Joe's perspective is going to look at this as fear-mongering. However, again, I think it's just being realistic of what the worst-case downside risk was, and that is what an investor is supposed to do. Keep in mind that during the time that Bill Ackman was doing this, like during that week, he was buying millions of dollars worth of stock. So it's very important to understand that this is what value investors are supposed to do. We are supposed to look a very scary and uncertain market in the face, look at the fundamentals, look at the financials, look at what could be increasing and decreasing risk and offering a higher reward with lower risk, and we should be trying to take advantage of it no matter how bad it hurts to rip off that Band-Aid. And this is just a great example. And then the last video clip that I wanted to show was one with Joe talking to a very regular guest on CNBC, Mohamed el-Erian. And this guy is a very good contrast to Joe, showing their different perspectives. Now, Mohamed is much more of a risk-averse investor, even more so than I am. And you'll be able to tell that from this video. But let's start with the first clip.
Ways of trying to decide what the market keys on, Mohamed.
All three, depending on what type of investor you are. Look, I have said continuously, and you push back against that, it's much easier to make a judgment about specific companies and 4 attributes in particular that are stressed than it is to make judgment for the market as a whole. And those attributes have actually outperformed both on the way down and on the way up. And they're positive for the year, significantly positive for the year in some cases. So look for particular attributes. That's what's going to navigate us through. If you're a tactical investor, you're looking for policy. If you are more of a strategic investor, it's about science and reopening. And I think that the reality is we are a mix of everything. So I'd rather build it up from the bottom than top down.
Yeah.
And this is exactly what I'm talking about. Mohamed goes through a very cohesive argument of pointing out that just because the market's not doing well doesn't mean there aren't deals in the market. And you need to look at what type of investor you are, whether you're more of a trader, whether you're more of a value investor, whether you're more of a growth investor. And you need to figure out what you're looking for in a company. And when you see those, realize there are deals in the market. And that is a very important way to look at it from an investor standpoint. There is always a deal in the market. It's just whether or not you are in a position to be able to capitalize on it and whether or not it fits your risk reward profile. And that's what he's talking about here. And he even goes in to point out that it depends on what style of investor you are. You know, Joe wants a strict one-way answer similar to the original clip. Joe wants a strict one-way answer of, oh, is it time to buy or is it not time to buy? And that's not a responsible way to ask that question because it all comes down to your individual investing goals. Now let's go to the next clip. Let's go to the next part of this interview, which is at 4:25.
Out of place to be.
So, Joe, I suggested 4 attributes for the last, I don't know how long. One is strong balance sheet, which means either no debt, or little debt, or means access to capital. 2, positive cash flow. 3, strong management teams. 4, what you just said, on the sunny side of both the COVID shock and the post-COVID world. There are companies that meet those 4 criteria, and they've been doing relatively well in this whole environment, and I suspect they will continue to do well. I have no issue with the relative pricing
And this is, again, hammering home what I've been doing and what I've been talking about on my channel is that you just have to focus on good quality companies. And one thing Mohamed talks a lot about is he'll say up in quality on the way down, and Joe will get upset with him often saying that, you know, you're sitting on a fence, you're not saying a true answer. But the reality is that's what you should be doing in a down market, is when there's increased risk, you should be increasing the quality of the companies that you have. That way you're lowering your risk profile while not missing out on good deals. And his focus on companies with good balance sheets, good cash flow, good management teams, and a good opportunity on the back end as well as during, because that's another thing is a lot of investors focus way too much on what companies are succeeding during the downturn because of it, not what will succeed after the downturn. Short-term trading is not what I'm in the game for. It's not what Mohamed's in the game for. It's investing. We're looking for what is the best long-term way to deploy money, not what is the best way to turn around a quick profit. And then the last clip in this video I want to go to is right here. And this is talking about the recovery shape.
And the political autonomy of the Fed would be weakened.
What kind of, is it, we looking at a Nike swoosh? It's not a V, it's not a U, it's not an L. What is it now? You got a symbol for it? Maybe it's Elon Musk's kid.
It's
looks
a
like
series of W's.
It's a what?
Good joke by Joe.
W.
So it's a series of W's. No, think of a pendulum. We swung from everything fine to complete shutdown now we're having partial unsynchronized reopenings. Some of them are going to go well, some of them are not going to go well, and the pendulum is going to continue swinging with lesser and lesser magnitude.
And I think this is exactly the deal, is we have to recognize that right now when there's a lot of uncertainty in the market, that there's going to be big swings both in the negative and the positive direction. And we need to just make sure that we know what we're looking to buy and be ready to buy when those stocks go on sale, i.e. when a stock has a down day, pick up a little bit, nibble just a little bit every single time you get the opportunity. That way you don't miss out on it. Overall, I just wanted to make sure that this got covered because I think that it shows a very good example of what investors are struggling with right now. We're stuck between whether we're bears, whether we're bulls, and the reality is that regardless of the market, investors should be acting in the same way. That you look for companies that are good deals, that have a good balance of risk and reward opportunity, and we should take advantage of those when they're on sale. We don't want to be like Joe where we're constantly looking for an all or nothing answer, because the reality is that's not how it works. The beauty of investing and the challenge of investing is being willing to pull the trigger when it's time, when things look bad, when everything looks like it's going down to zero. That's when you want to be pulling the trigger, and that's why I've been buying so many stocks over the last 2 to 3 months whenever they're down, to be able to capitalize on that. And so far, it's doing really well. That being said, as Andrew Ross Sorkin points out in this, he doesn't know what's going to happen. Investors don't know what's going to happen. And realistically, it seems to me that the market is currently overvalued. That being said, I know that the stocks that I have aren't currently overvalued, and I know that the prices that I have on them are good. And that's why I'm probably going to continue holding all of them unless the risk changes on them. And when it drops, I'm going to keep a level head and continue to pick up more and more shares, increasing the positions that I have and picking up other stocks that I like. And that's what we should all do as investors. Thank you guys for watching this. I know this is a little bit of a departure from my normal videos, but I thought it was an interesting topic. Want to make sure that it got discussed, and want to make sure that when we're looking and watching these, talking heads, that we are reading between the lines and understanding how to think for ourselves, as opposed to just picking a side based on emotions or politics. And that's why I think it's a really good lesson for investors everywhere. Again, thank you guys for watching the video. I will see you guys next time, and be sure to leave a like, comment below what you think about the market and about this interaction. And also don't forget to look in the links below if you want to see the original videos, and also be looking down there for a referral link for Webull. It's a stock trading platform. I talk about it in a bunch of different videos, and basically if you sign up, you deposit $100, you'll get a free stock. And what's better than free money with a platform that's already really good? Be sure to use that. Let me know what stock you get, and I will see you guys next time.